The topic for this video is Module 7, Industry Controls, Chapter 18, Risk Management for the CFA Institute Investment Foundations Program. So here we are in Module 7, Industry Controls. The topic for this video is Chapter 18, Risk Management. There are 9 learning outcome statements. And as you can see, there are 53 questions in the online learning ecosystem. The learning outcome statements for this chapter are Learning Outcome Statement A, define risk and identify types of risk. B, define risk management. C, describe a risk management process. D, describe risk management functions. E, describe benefits and costs of risk management. F, define operational risk and explain how it is managed. G, define compliance risk and explain how it is managed. H, define investment risk and explain how it is managed. And I, define value at risk and describe its advantages and weaknesses. Learning Outcome Statement A is define risk and identify types of risk. Risk arises out of uncertainty. It can be defined as the effect of uncertain future events on a company or on the outcomes of the company that the company achieves. One of these outcomes is the company's profitability, which is why the effect of risk on profit or rates of return is often assessed. Events that have or could have a negative effect, leading to losses or negative rates of return, tend to be emphasized in discussions of risk. Some of these events are external to the company. For example, a bank that has a large portfolio of commercial loans may suffer substantial losses if the economy goes into a recession and corporate defaults increase. Other events, such as fraud or network failure, are internal to the company. But not all outcomes from events are negative. Some events can have a positive effect on the company, creating opportunities for gains. For example, a company that takes the risk of investing in a country with tight capital controls may benefit when the capital controls are partially lifted and it becomes one of the few foreign companies licensed to buy and sell securities in that country. So the assessment of risk needs to include opportunities as well as threats. Now the next 3 slides are my own and just some thoughts on risk, because as we've been going through the CFA Institute Investment Foundations program in the different chapters, equities, we've seen certain types of risk. On bonds, certain types of risks. We read about risks in the economic sections. We've followed some of the risks in investor and their needs. We talked about risk objectives, willingness and ability to take on risk. So I thought I'd just summarize some of those things from the individual investor side, because this chapter is really focusing on kind of the institutional risk management. So I just thought anyhow I'd throw in a little quick review of risk from the investor side. So there's many risks faced by investors. Investors who choose to be safe and keep a large percentage of their assets in cash are facing unanticipated inflation risk. The purchasing power of the cash will erode in the face of inflation. So in his book, Asset Allocation, Balancing Financial Risk, Roger Gibson emphasizes the importance of understanding risk in the market. I like this quote, that's why I selected it. And his quote is, "Clients often misperceive the risks they face in the investment of their money. If these misperceptions remain uncorrected, these clients very likely will make portfolio decisions that are not in their best interests. This highlights the value of providing to the client a detailed historical review of the capital markets. A client who fully understands inflation risk, interest rate risk, credit risk, and equity risk is in a much better position to make intelligent investment decisions appropriate for their financial goals." So as you know, I like to spend a lot of time trying to educate people with regards to the investment industry, not only the returns, but also the risks, okay? And as you can provide clients with, historical review of the capital markets, then there's less opportunity for disappointment. What's disappointment? It's the gap between expectations and reality. If you can educate and get those expectations set properly, then you're going to reduce the opportunity for disappointment, because the realities of investing, having a down year, that's understood, it's been educated, and it meets the expectations, okay? Long-term on average, stocks have got the best return, but in the short term, there's more volatility. That's the type of education that you need to give. But there's also inflation risk, interest rate risk, credit risk, many other risks. We're just going to go through the quick list in the next 2 slides. As we've seen in the various chapters, the types of risk an investor is exposed to depends on the investment. If an investor buys government bonds, then the investor is faced with interest rate risk. The principal value of a bond fluctuates with interest rates. As interest rates rise, bond prices decrease. In 2013, the yield on a 30-year United States Treasury bonds increased from 3.04% at the beginning of 2013 to 3.96% at the end of 2013. The return on the 30-year United States Treasury was negative 15.03%, although it's still a bond. Most people think they're very low risk, but you can see in 2013 a large capital loss due to the increasing the rates. Rates go up, prices go down. But note that this is an unrealized loss, and if the investor holds the bond until maturity, that loss is not materialized. Okay, moving on. Investors who buy corporate bonds or high-yielding bonds can be exposed to default risk, which is the risk that the principal does not get paid back. Investors who buy equities are exposed to market or systematic risk. A rising tide lifts all boats. Owning individual stocks exposes an investor to company-specific or unsystematic risk. This is a particular risk to individuals who participate in stock purchase programs and have a large percentage of their portfolios tied up in the stock of their employer. Investors seeking to diversify and invest in another country or another currency face exchange rate or currency risk. The value of the currency of the investment could decrease, which would decrease the purchasing power of the home company. The home currency. Investors who seek higher returns by investing in more risky assets, like some types of hedge funds that we saw in the chapter on alternative investments, there might be exposure to liquidity risk. It may not be so easy to sell the asset. There may be contractual holding periods. The risk needed to meet an investor's objectives may be lower than expected. This can lead to shortfall risk. With the increasing focus on frontier markets and emerging markets, investors may be exposed to regulatory risk. Finally, for some people, their biggest asset is their human capital, and there are risks faced by people that in some cases can be mitigated by various insurance policies. So that was just 3 quick slides, risks from the point of view of the investor. Now we're going to move on to the content from the chapter, and which is primarily the focus of risk management within investment companies. So now we're back to the Foundations chapter material, and we're moving on to classification of risk. Risks are classified according to the source of uncertainty. There's a long list of sources of uncertainty, so there's a correspondingly long list of risks. Relatively well-defined categories of risks exist, but no standard risk classification system applies to all companies because risks should be classified in a manner that helps managers make better decisions in context of their particular company and its environment. However, there are 3 risks to which companies in the investment industry are typically exposed. Number 1 is operational risks, which refers to the risk of losses from inadequate or failed people, systems, and internal policies and procedures, as well as from external events that are beyond the control of the company, but that affect its operations. Number 2 is compliance risk, and compliance risk is which relates to the risk that a company fails to follow all applicable laws and regulations and faces sanctions as a result. Finally, the third type of risk is investment risk, and that's the risks associated with investing that arise from the fluctuation in the value of the investments. Although it is an important risk for investment professionals, it is less important for individuals involved in support activities, so it receives less coverage than the operational and compliance risks in this chapter. So again, some of the investments risks have been discussed in other chapters, and that was the purpose of my 3 slides. The rest of this chapter is really focusing on operational and compliance risks. So a quick practice question from the learning ecosystem at the difficult level. Which of the following situations most likely increases an organization's compliance risk? A, using agents and third parties. B, separating the front and back offices. Or C, monitoring and controlling business processes. Okay, the correct answer is A, using agents and third parties most likely increases an organization's compliance risk, okay? If we look at B, separating the front and back offices, no, that will reduce an organization's compliance risk. Remember, compliance risk is the failure to follow laws, etc. And going back to chapter 13, the structure of the investment industry, we learned that the front office deals with the clients. Those are the activities: sales, marketing, customer service. This is how when I go forwards and learn something new, I go back and I like to review and recycle. And that's how it becomes an iterative process, whether you're doing the CFA Institute Investment Foundations program or the CFA program. The CFA program, much more content. So you got, as I said before, you got to move ahead and you got to go back and review. So when you're looking at the compliance risk and you see a question here separating the front and back offices, I like to go back and remember, oh yeah, front office is sales, marketing, customer service. Back office is accounting, human resources, payroll, and operations. Remember, compliance runs through all offices from front to back. And the middle office is risk management, IT, corporate finance, portfolio management, and research. And then I remind myself the CRO, Chief Risk Officer, is going to report to the Board of Directors, and the internal auditors are going to report to the Audit Committee on the Board of Directors, okay, internal audit. So I go back, when I look at these questions, I'm going to look at I use it as an opportunity to review. So separating the front and back offices, that's definitely going to, decrease a compliance risk, and here the word was increase. So make sure you read the questions with laser-like accuracy. And C, monitoring and controlling business processes. No, throughout risk management, we're talking about monitoring and controlling business processes that'll decrease an organization's compliant risk. So read the questions carefully and go back and review. When you see an opportunity to see something, go back and review it. Learning outcome statement B is define risk management. Risk management is a process, that is, a series of actions to achieve a company's objectives. These objectives may take different forms, but they are typically driven by a company's mission and strategy. A common corporate objective is to create value in a business environment that is usually fraught with uncertainty. So an important objective of the risk management process is to help managers deal with this uncertainty and identify the threats and opportunities their company faces. One of the main functions of risk management is to find the right balance between risk and return. Shareholders in a company or investors in a fund have invested their money for the promise of a return at some risk level. By limiting the effects of events that may derail the company's ability to achieve its objectives while benefiting from opportunities to grow the company profitably, risk management plays an important role in delivering value for these shareholders and investors. Risk management is defined by the Committee of Sponsoring Organizations of the Treadway Commission. There's an abbreviation for this, COSO, which provides guidance about risk management, internal control, and fraud deterrence. So risk management is defined as a process effected by an entity's board of directors, management, and other personnel, applied in a strategy setting across the enterprise, designed to identify potential events that may affect the entity and to manage risk to be within its risk appetite, and to provide reasonable assurance regarding the achievement of entity objectives. This definition is broad, but it highlights the key concepts associated with a risk management framework. The involvement of the board of directors and senior management in risk management is critical because they set corporate strategy and strategic business objectives. Although directors and senior managers are in charge of setting the appropriate level of risk to support the corporate strategy, risk management should involve all employees. One employee making an inaccurate or fraudulent assessment can damage the reputation of his or her company and even lead to its demise. Learning outcome statement C is describe a risk management process. So you can see here we've got a list. Anytime we have a list, we need to really memorize the order of the list. Sometimes there's most likely or least likely is a step, following a step or before a step. So we want to make sure that we memorize the list and in the correct order. So number one, the risk management process is to set objectives. Number two is to detect and identify events. Number three is to assess and prioritize risk. Number four is to select a risk response. And finally, number five is to control and monitor. That's the risk management process. We'll be looking at some of this in more detail in the upcoming slides. So we're going to look in more detail at the first step, setting objectives. Setting objectives is an important part of risk management, and it enables management to identify potential events that could affect the realization of those objectives. An important element in the setting of objectives is the company's risk tolerance, which is the level of risk that the company is able and willing to take on. The ability to handle risk is primarily driven by the company's financial health and depends on its level of earnings, cash flow, and equity capital. Its willingness to take on risk, which is also called its risk appetite, depends on its attitude towards risk and its risk culture. So you can see, very similar to when we were looking at the risks of individuals and families as part of the investor needs before the investment management. One of the first things is to determine the investor's objectives, and the second thing is to return objectives, capital preservation, growth of capital, income, total return, etc. Going from a very conservative profile to one of more of aggressive growth. So we look at the return objectives, but not only considering return, but also the risk. And we looked at the investor's ability and willingness to take on risk. Ability is financial health, and willingness is more psychological factors, which is harder to quantitatively measure and is sometimes done with individuals through questionnaires, etc. So very similarly, when we're looking at a company's objectives here, they're also talking about the ability and willingness to take on risk. Okay, risk management enables management. Risk management enables management to identify potential events that could affect the realization of those objectives. So a company may set strategic objectives, which are typically high-level objectives connected to its mission. It may also define objectives that are related to its operations. A strong risk management process helps decision makers ensure that the company is on track to achieve its objectives. So after setting the risk objectives, the second step is to detect and identify events. Okay? So the next step in risk management is to detect and identify events that may affect the company's objectives. As previously mentioned, the outcome events can be negative, potentially leading to loss of earnings or assets, or they could be positive. The aim of risk management is to try to capture the full range of risks, including hidden or undetected ones. Therefore, companies should involve staff who are in different roles in business areas to detect and identify as many events as possible. But there will always be unforeseen hazards. No matter how hard people try to reduce risk, it can never be completely eliminated. The complexity of the business environment makes it impossible to understand and model the large number of possible outcomes and combinations of outcomes with much hope for accuracy or even comprehensiveness. So what risk management provides is a robust framework. It's a framework to help companies prepare for adverse events, identify their occurrence as early as possible, and if they do materialize, and thus reduce their impact. The process of identifying potential risks can also at times reveal hidden value-enhancing opportunities. So now we're on to assess and prioritize risk. So that's step number 3. Recall step number 1, set risk objectives. Step number 2, detect and identify events. Step number 3, assess and prioritize risks. So you can see we're dealing with a matrix here. On the lower axis here, we've got expected frequency. On the y-axis, we've got expected severity. And so we're putting together a grid or a matrix. So you can see here in terms of the expected frequency, highly unlikely is very green. In terms of the expected frequency, not very highly unlikely, possible, likely, and very likely. So that's kind of the probability of occurrence, I would say. And then here on this, as we move up, you can see the expected severity starts from negligible. So if a risk event is highly unlikely and its expected severity is negligible, we can see it's green. You don't need to spend, there's not much attention is given to that risk. But as we move up, you can see from negligible to the expected severity being slightly harmful, or extremely harmful to catastrophic. So you can see here where you're going to put it shows you where the effort, green is not much attention, yellow is a little bit more, you can see as we go through here. Then it moves up to situation orange, and black is highly unlikely, but it could be catastrophic. So you have to pay some attention to it. But here in the red zone, this is where a lot of attention has to be paid, going from possible to likely to highly likely, and the expected severity ranging from extremely harmful to very catastrophic. So red should receive the special attention. Okay, so both the expected frequency of a risk event and the expected severity of that event need to be considered when prioritizing risk and the appropriate response. So just a couple other things to note with regard to this catastrophic but highly unlikely. Because it's black, sometimes they're called black swans. They're usually not identified until after they occur. Okay, so in practice, selecting key risk measures is very important for risk management function to be proactive and preventive. Key risk measures should provide a warning when risk levels are rising. They require the collection and compilation of data from various internal and external sources. The types of key risk measures varies among industries and companies and needs to be reviewed regularly to ensure that the measures are still relevant and sensitive to risk events. So now we're moving on to the step, select a risk response. So again, step number 1, set risk objectives. Step number 2, detect and identify events. Step number 3, assess and prioritize risk. And now we're here selecting a risk response. Okay, so you can see here that the risk response strategies can be classified into 4 T categories. So you've got tolerate, treat, transfer, and terminate. Tolerate, this strategy involves accepting the risk and its effect. In some cases, the risk is well understood and taking it provides opportunities to create value. In other cases, the risk must be taken because other risk response strategies are unavailable or too costly. Moving to treat, this strategy involves taking action to reduce the risk and its effect. Transfer, this strategy involves moving the risk and its effect to a third party, for example, an insurance company. Insurance companies transfer the risk. And finally, there's terminate as the 4th T. This strategy involves avoiding the risk and its effects by ceasing the activity. In practice, financial firms set internal risk limits that incorporate the overall risk tolerance and risk management strategy. So, for example, by specifying the maximum amount of a risky security that can be held, or the maximum aggregate exposure to one asset type or to one specific counterparty. Defining and monitoring risk limits allows for risk response strategies to be implemented. So now we're moving on to the 5th and final step in the process, which is the control and monitor risks. So taking action in response to risk involves a range of controlling and monitoring activities that must be performed in a timely manner. Policies and procedures provide a framework to help ensure that the risk responses are effectively implemented and monitored. Relevant information must be identified, captured, and reported accurately to enable people to carry out their responsibilities. Risk management, like many processes, should be iterative and subject to regular evaluations and revisions. Results must be used to make appropriate adjustments, leading to a constant improvement in the risk management process. At some point, risks must be consolidated and managed at the firm level, bringing together different risks into an overall risk exposure. Enterprise risk management, ERM, helps a company manage all its risks together in an integrated way rather than managing each risk separately. The advantage of this approach is that it aligns risk management with objectives at all levels of the company, from the corporate level to the business unit level to the project level. So a quick practice question from the learning ecosystem at the easy level. Hey, let's do an easy one for a change. So risk matrix characterizes the risk of losses in terms of A, expected return and expected risk, B, operational risk and compliance risk, or C, expected severity and expected frequency. Yes, that's an easy question. C is correct. A risk matrix compares the expected severity of a loss with the expected frequency that a loss occurs. So again, we're just remembering that there's a matrix, but we want to remember kind of running on the what we call the y-axis side is the expected severity, and along the x is the expected frequency. Expected frequency going from highly unlikely, unlikely, possible, likely to highly likely, and the expected severity going from negligible, slightly harmful, harmful, extremely harmful, catastrophic. Catastrophic is highly unlikely to unlikely, if we look at the black, it's highly unlikely, unlikely, catastrophic, and we're going to call that a black swan because we rarely see it until after the fact. So moving on now to Learning Outcome Statement D, which is describe risk management functions. Risk management functions vary by company, but it is typical for companies in the investment industry to have a standalone risk management function with a senior head, often called the Chief Risk Officer, CRO, who is capable of independent judgment and action. The Chief Risk Officer often reports directly to the Board of Directors. So that's one key point important to understand. The CRO often reports directly to the Board of Directors, not to the CEO. The purpose of establishing a strong independent risk management function is to build checks and balances to ensure that risks are seriously considered and balanced against other objectives such as profitability. Despite the existence of specialist risk managers, risk management remains everybody's responsibility. So that's the second key point, is that risk management remains everyone's responsibility. Risk managers assess, monitor, and report on risks, and in some cases, they may have an approval function or a veto authority, but it is the members of the business functions, such as portfolio managers or traders, who own the risk of their deals. So that's a third kind of key point that I would bring up, is that members of the business functions, portfolio managers, traders, they own the risk of their deals in their department because they have the best knowledge, the intricate knowledge, sophisticated knowledge, okay? The risk manager must ensure that all relevant risks are identified, but the final judgment on the business decision lies with the decision makers. Those are the employees that have the most intimate knowledge of what they trade, and they must monitor their deals on a regular basis, okay? So over here, now we're getting into this sort of graphic, and they're talking about 3 lines of defense. So frontline employees and managers, through their daily responsibilities, form the first line of defense against risk, okay? The second line of defense, the risk management and compliance groups operate as the second line of defense, and then finally the internal audit function then forms the third line of defense, okay? We talked about that a little bit perhaps in financial statements, the accounting, the difference between internal audit and external audit. External auditors come in and look at your financial statements and give you an opinion. And give you a letter that you can put, if it's a publicly traded company, you get the auditor's letter, and it's at the front of the annual report, the front of the financial statements. And then internal audit is the company employees looking at internal operations and procedures and ensuring that there's compliance. So internal audit is the third line of defense, okay? Okay, Learning Outcome Statement E is describe benefits and costs of risk management. So you can see benefits of risk management. We've got a list here: 1, 2, 3, 4, 5, 6, 7, 8. It's good to memorize our lists, and this would be a lot like my flashcard. I might even simmer this down. So one of the first benefit of risk management, supports strategic and business planning. Number 2, incorporates risk considerations in all business decisions. 3, prevents excessive risk-taking. 4, brings greater discipline to operations. 5, recognizes responsibility and accountability. 6, improves performance assessment. 7, enhances information flow. And finally, number 8, complements compliance procedures and audit testing. So 8 benefits of risk management. You need to memorize them, create some type of mnemonic that helps you remember. SIPBRIEC, something like this, and create something that will help you memorize the 8 benefits of risk management. Okay, now we're moving on from the benefits of risk management to focus on the costs, okay? The costs of risk management. So the costs of establishing risk management systems range from tangible costs, such as hiring dedicated risk management personnel, putting more procedures in place, and investing in systems, and intangible costs. So much like accounting, tangible assets are things that we can see and touch and feel. Intangible assets are things that we can't, are harder to touch or feel. And so an intangible cost, nevertheless, would be slower decision making and lost opportunities. That would be an opportunity cost, okay? Allocation of resources to risk management should be based on cost-benefit analysis. However, it is difficult to weigh the costs and benefits of risk management precisely because it's impossible to observe, let alone measure, the cost of potential catastrophes that are averted, okay? So it is only in hindsight that the cost-benefit trade-offs may be identified. So a case in point is Barings Bank's collapse in 1995. It was triggered by huge trading losses hidden in the Singapore branch. At the time, there was no adequate and effective system for reconciling client orders and trades on a global basis, although such a system could have revealed the losses before they wiped out all of the bank's equity capital. It is estimated that implementing the system would have cost about £10 million, which is a small price to pay compared with the £287 million loss that brought down Barings. Practice question from the learning ecosystem at the expert level. Alpha Managers Limited Liability Company appoints a new risk management group, and the CEO declares a cost-benefit analysis will demonstrate the value of this group to the firm. Is the CEO's statement accurate? A, no, because there are intangible costs. B, yes, because the cost of establishing a risk management function are tangible. Or C, yes, because all business decisions can be exactly measured on a cost-benefit analysis. Actually, I don't think that question's so difficult, So if we look, so the CEO declares a cost-benefit analysis will demonstrate the value of this group to the firm is inaccurate. And it says, yes, because the costs of establishing a risk management function are tangible. No, that's wrong. So, that's a false, okay? Because we know it's tangible and intangible. There's tangible and intangible costs. The intangible costs, slower decision making or some type of opportunity cost. If you look at C, all business decisions can be exactly measured on a cost-benefit basis. No, there's simply too many factors and too many decisions to be exactly measured. So exactly is the wrong word there. So sometimes if no, B and C are wrong, A has to be right. So sometimes that's another technique for tackling the multiple choice questions is look at no, I know that one's wrong. No, okay, I haven't even started to read it, but I know it's probably right. And it says here, is this statement accurate? No, because they're intangible costs. That's okay. So that's the right one. I don't think that's too difficult if you understand that the cost-benefit analysis on the cost side, it includes tangible costs and intangible costs. Learning outcome statement F is define operational risk and explain how it's managed. So you can see there's managing operational risk. There's 4 areas. 1 is managing people. 2 is managing systems. 3 is compliance. And 4 is managing the environment. So there's 4 PowerPoint slides with regards to managing operational risk. And the first one is focuses on managing people, okay? So operational risk is the risk of losses from inadequate or failed people, systems, internal policies and procedures, as well as from external events that are beyond the control of the company, but that affect its operations. In terms of managing people, human failures range from unintentional errors to fraudulent activities. Many companies are exposed to occupational fraud, sometimes called internal fraud or employee fraud, which is when an employee abuses his or her position for personal gain by misappropriating the company's assets or resources. Rogue trading refers to situations wherein traders bypass management controls and place unauthorized trades, at times causing large losses for the companies that they work for. Rogue trading may involve fraudulent trading that is done for personal enrichment or to make up for losses. Companies can mitigate operational risks through education by clearly communicating policies and procedures and by having efficient and effective internal controls. Good human resource management, HR management processes are also critical for business success. Hiring the right people and motivating them with the right incentives are well-known ingredients for success. Risk management from an HR perspective covers such precautions as carrying out background checks, for example, criminal record and disciplinary records with regulators for new hires, so it starts even before the employee is hired, verifying credentials and previous work experience, performing personality assessment tests, and getting character references to confirm suitability. Although these steps may appear to be standard procedures, studies have shown that discrepancies between presented and actual credentials are very common. That's the great thing about the electronic badges now. Once you pass this course, you get the CFA Institute electronic badge showing your name and the certificate, Investment Foundations Program. And of course, I always recommend to people to use the name exactly as it appears on your passport. Just start that track record off right with the with CFA Institute data. So again, for your electronic badge, get the name on it to match your passport exactly. That's my advice. Okay, anyhow, moving on, risk-taking should also be considered in the structure of compensation for employees when defining bonus payments for employees who expose the company to significant risks, such as traders and other investment staff. A good compensation system should take into account the level of risks undertaken for a given level of return and should reward those who can achieve returns without taking excessive risks. An example of an incentive that could lead to fraudulent or dangerous behavior is rewarding traders for profits regardless of the risks that they take, which would give them all the upside for trading gains but less downside for trading losses. In practice, traders generally generating substantial losses typically lose their jobs and reputations, but they do not have to pay back much compared with the vast amounts they typically deal in and the bonus payments that they previously received. Some authorities are now imposing new remuneration structures, which include deferred compensation to take into account long-term performance, as well as clawback provisions whereby employees may have to return their bonuses if reported profitable deals result in losses later. Moving on now to managing systems. Companies rely heavily on IT systems. Consequently, it has become an increasingly important source of operational risk. Automated processes can reduce the frequency and severity of operational errors, but they are not infallible. Failures of IT and communication systems can paralyze business operations or greatly reduce their efficiency, harming the company's profitability via lower revenues, higher costs, or a combination of both. IT networks are inherently vulnerable to disruptions and outside interference because both technical limitations and human factors. One source of risk is the behavior of employees who do not always follow internal company guidelines and download unauthorized applications for personal or business use. The dangers include malicious viruses and unlicensed and perhaps incompatible software getting into the company systems. In addition, IT departments are in a constant battle with hackers who exploit weaknesses to penetrate systems. Key controls to protect systems and business information include establishing and communicating policies and standards for users and IT technical staff, creating appropriate security standards and configurations for systems, and in general, allocating adequate personnel and technical resources to maintain a well-controlled IT environment. Protecting confidential information is also important in the investment industry. Data privacy has received a great deal of prominence recently because of a number of cases in which companies and government agencies lost vast amount of people's personal information, exposing them to the risk of fraud. A company should understand how data are produced and flow internally, classify the information by sensitivity, assess the risks of data loss, and adopt appropriate measures. Many companies have strict laws and regulations for protecting customer data, along with severe penalties for violating these laws and regulations. Moving on now to compliance. Complying with internal policies and procedures. The structure of a company varies with size and business activities engaged in, but there are features common to all companies. For instance, power and authority are delegated and responsibilities are assigned within most companies. Policies and procedures should explicitly set out the delegation of authority and define clear responsibilities and accountability. These definitions form the basis for the monitoring of and control over business processes and provide feedback mechanisms. The segregation of duties is an important principle that international companies and regulators and other authorities in many countries require and recommend. As mentioned earlier, a clear separation needs to exist between front and back offices. In accounting departments, there should also be a clear separation between those who enter items into the accounts and those who reconcile the bank statements with the cash balances in the accounting system. Compliance and internal audit functions are key to ensuring that employees are actually following the internal policies and procedures. And finally, we're down to the last slide for this learning outcome statement regarding managing operational risks. We're going to be looking at managing the environment, and we're going to be looking at political risk, legal risk, and settlement risk. So starting with Political risk. Political risk is a risk that a change in the ruling political party of a country can lead to changes in policies that can affect taxation, money supply, interest rates, credit, investment incentives, public investments, and procurement. Some industries are heavily influenced by governments that, for example, control natural resources or set prices of raw material inputs or products. In these instances, a change in administration or policies can affect the value of the investment. Political risk is inherent in all countries and should always be considered, even if it is perceived to be relatively remote. Legal risk is the risk that an external party could sue for breach of contract or other violations. A company should consider how it identifies and conforms to all legal commitments it has undertaken. The role of an in-house legal expert is crucial in controlling legal risk. Most areas of a company have dealings with external parties, such as deal counterparties, business partners, suppliers, and service providers. An important control in managing the legal risk of these business relationships is to have legal experts review every contract. The most significant deals usually require approval at the level of the board of directors. The storage of records, documents, and all forms of communication must also be in line with legal requirements for all relevant jurisdictions. Moving on to settlement risk or counterparty risk is the risk that when settling a transaction, a company performs one side of the deal, such as transferring a security or funds, but the counterparty does not complete its side of the deal as agreed, often because of declaring bankruptcy. A counterparty is more likely to find it difficult to fulfill its obligations during challenging economic times or when bankruptcy is imminent than during profitable times. In the case of bankruptcy, it may take months or years to receive assets through a bankruptcy resolution procedure, and the proceeds may only be a fraction of the original nominal amount of debt. It is important to distinguish the risks inherent in bilateral agreements from those in transactions contracted through central counterparties such as clearinghouses. Clearinghouses may step in to assume the risk of a counterparty failing to meet its contractual obligations. We saw that on the chapter where we looked at the difference between forwards and futures. Futures are traded on an exchange, so there's less counterparty risk because the exchange has certain mechanisms to reduce that: original margin requirements, mark to market on a daily basis, and margin calls, whereas forwards are private contracts are subject to more counterparty risk. So we've looked at some of this stuff. That's why I said there's a lot of overlap as we go along. It gets easier and easier. Okay. Anyhow, other arrangements to reduce this risk are margin requirements and standardized agreements. Yeah, that was the other thing, standardized agreements with future contracts. And so that's the last slide for this four-slide series on managing operational risk. Quick summary: managing people, managing systems, compliance, and managing the environment, and which includes political risk, legal risk, and settlement risk. Learning outcome statement G is define compliance risk and explain how it is managed. Okay, so remember, going back to the classification of risk, again a quick review. Number one, operational risk, human errors, internal fraud, things outside that external we can't control. Number two is compliance risk, that's what we're going to look at now. And then three is investment risk. We spend less time in this chapter. And then a quick review: the compliance risk, the operational risk. We looked at, in terms of operational risk, we looked at managing people, managing systems, compliance, and managing the environment. So now we're moving on to compliance risk, okay? So compliance risk is the risk that a company fails to comply with all applicable laws and regulations. The risk of non-compliance with laws and regulations is higher than non-compliance with internal policies and procedures because sanctions can be applied. These sanctions can affect both individuals and companies and may be severe. Many people believe that the trend towards less regulation contributed to the global financial crisis that began in 2008. The trend has reversed with the reimposition of greater regulation and oversight. This increased legislation, in turn, has led to more compliance activities and more compliance risk. The framework for, let's look at the framework for legal and regulatory compliance. In addition to applicable rules, laws, and regulations, many investment firms must follow guidelines from regulators, stock exchanges, and industry associations that have been given powers to oversee members. Because of their importance in the financial system, banks and insurance companies have historically been subject to heavy regulation, with detailed rules and scrutiny from regulatory authorities. Companies should have internal reporting procedures to encourage employees to come forward and report instances in which they suspect someone has violated internal policies, procedures, laws, or regulations. This process is called whistleblowing and has become an important way for authorities to learn of violations. Provisions to protect and reward whistleblowers have been strengthened in the wake of financial scandals. So that's an important thing to understand, is that a framework for legal and regulatory compliance is that whistleblowing is kind of encouraged. It's an important way for authorities to learn of violations, but there need to be provisions to protect the whistleblowers, because they're putting themselves out there. And now we're going to look at examples of key compliance risks. So in the text, there's the section on corruption, section on tax reporting, section on insider trading, and a section on anti-money laundering. So there's 4 sections: corruption, tax reporting, insider trading, anti-money laundering, 4 examples of key compliance risks. First, looking at corruption, which is defined as the abuse of power for private gain, has received heightened attention because of tightened laws and regulations on bribery and increased regulatory scrutiny, investigations, prosecutions, and fines. Some national authorities may apply these laws extraterritorially, even to foreign entities. To safeguard against corruption, companies must start by establishing a tone at the top, with senior management communicating an unambiguous policy of zero tolerance for unethical business practices and bribery. Tax reporting is complicated because the principles and rules vary considerably by jurisdiction. Companies are continuously developing financial and legal structures, often with the intention of minimizing taxes overall. There is a technical difference between tax avoidance, which means using tax code provisions to minimize the tax that is owed, and tax evasion, which means not paying taxes in violation of the law. So that's an important thing to understand, the difference between tax avoidance. You can avoid tax, you can minimize your tax using available laws and codes and provisions, but tax evasion means not paying taxes in violation of the law. So just remember the difference between avoidance and evasion. Insider trading. There are laws that prohibit the trading of a security when in possession of important confidential information pertaining to the security in question. Companies must implement policies and procedures to ensure that traders understand the laws and that nobody in the company will be in the position to violate them. Investment firms may face a high risk of insider trading, such as investment banks. Investment banks have control rooms to monitor information flowing between the teams. They also have virtual walls or information barriers to restrict and segregate information and to manage other conflicts of interest. These walls are sometimes called Chinese walls. So that would be a separation between investment banking, where they're working on a merger and acquisition. In the trading department, there's a Chinese wall that segregates the information, no flow of information between the two departments. Moving on to anti-money laundering. Anti-money laundering legislation is a set of rules to prevent money derived from criminal activities from entering the financial system and acquiring the appearance of being from legitimate sources. International agreements defining basic principles and requirements for anti-money laundering frameworks have been developed and are implemented with slight variations according to the jurisdictions. So a quick practice question from the learning ecosystem at the expert level to check our understanding. And the question is, to reduce expenses, a small investment firm is considering combining its trading desk and its back office operation. If it does so, the firm will increase its exposure to A, business risk, B, compliance risk, or C, operational risk. Okay, this one could be a little bit tricky. Some people thought, it could be operational risk or compliance risk. I think there's kind of a fine line between the two. Because by combining your trading desk and its back office, you're definitely opening up to some kinds of operational risks. But if we look here, the classification of risk, remember, number 1 was operational risk. That was from human errors, internal fraud, or external things that we can't control. Number 2 was the compliance risk, failure to follow laws. So it's saying B is correct. The segregation of duties is an important principle of managing compliance risk. A clear separation needs to exist between investment firms' front and back offices. So A is easily incorrect because business risk is the risk of not being able to operate profitably in a given competitive environment. But looking at C, if you thought C could be right, well, it's saying that operational risk refers to the risk of losses from the human, system, and process failures and from events that are beyond the control of the organization but that affect its operations. Okay, so compliance risk is more right because than operational risk. Learning outcome statement H is define investment risk and explain how it is managed. So investment risk can take different forms depending on the company's investments and operations. Firms in the investment industry typically experience three broad categories of investment risk: market risk, credit risk, and liquidity risk. Market risk arises from price movements in financial markets and can be classified into the risks associated with the underlying market instruments: equity price risk, interest rate risk for debt securities, foreign exchange risk, and commodity price risk. Many investment firms often implement an approach called risk budgeting to determine how risk should be allocated among different business units, portfolios, or individuals. Market risk that cannot be tolerated must be mitigated, and companies have different alternatives available. Credit risk. When assessing the credit worthiness of borrowers, it is important to consider both their ability and willingness to repay their debts. The expected loss from credit exposure is a function of three elements. So this is really important. The expected loss from credit exposure, three elements. This is a list that you need to remember. Number one, the amount of money lent to a particular borrower. Number two, the probability that the borrower defaults. And three, the loss that would be incurred if the borrower defaults. So again, lending to governments or state-owned companies creates another type of credit risk. That is sovereign risk. Sovereign risk is the risk that a government will not repay its debt because it does not have either the ability or the willingness to do so. Finally, liquidity risk refers to the ability to buy and sell quickly without incurring a loss. Firms in the investment industry face a greater level of liquidity risk than, say, manufacturers. To operate profitably, they need markets that can accommodate their trades without significant adverse effect on prices. When markets are illiquid, either temporarily, such as during a financial crisis, or more structurally, such as in some emerging markets, the ability to trade assets is substantially reduced, which has a negative effect on these firms. Now we're looking at greater detail in managing market risk and risk budgeting. Okay, so again, you can see there's another list. There's some steps here. Many investment firms are in the business of taking investment risks, and they tend to tolerate market risks, okay? But like any other company, they must align their risk profiles with their risk tolerance. They often implement an approach called risk budgeting to determine how risks should be allocated among different business units, portfolios, or individuals. For an example, an asset management firm may use the following risk budgeting steps. So step number one is to quantify the amount of risk that can be taken by the company at the whole, at the top level, the company. Step number two is to set risk budgets and limits for each asset class and or investment manager. Step number three is then to allocate assets in compliance with the risk budgets. And finally, number four, of course, is to monitor to ensure that risk budgets are respected. Market risk that cannot be tolerated must be mitigated, and companies have different alternatives available. One of them is to hedge unwanted risks by using derivative instruments. So that's an important thing to understand, is that you can hedge away certain unwanted risks by sometimes using derivative instruments. Now we're moving on to credit risk, okay? There are various approaches to companies' credit risk management, including the following. Number one is to set limits, okay? Set limits on the amount of exposure to a particular counterparty or level of credit rating allowed. For example, a maximum limit of 5% exposure could be set for a particular counterparty. Require additional collateral and impose covenants. Covenants are terms for loans that specify both what a borrower must do, positive covenants, and what a borrower is not allowed to do, which are negative covenants. For example, a bank may restrict borrowers from issuing more debt, paying dividends, or entering into highly risky business ventures. When one of the restrictive conditions is broken, the lender may recall the loan or demand some action, such as the assignment of additional collateral. Sometimes you can transfer risk, again, we mentioned, by using derivative instruments. And finally, credit default swaps are often used when companies want to protect themselves against the risk of a loss in value of a debt security or an index of debt securities. A quick practice question at the expert level from the learning ecosystem to check our understanding, and the question is, the expected loss from extending credit is a function of which of the following elements? A, amount of exposure and probability of loss, B, probability of default and loss given default, or C, probability of default and discount on collateral. So yeah, that's an important list to remember and memorize. The expected loss from extending credit is a function of three elements, okay? So number one is the amount that the lender is exposed to a particular borrower. So that's easy to remember. How much did I loan? But then it's these 2 points. It's the probability that the borrower defaults. So that's going to be some type of percentage. Our probabilities are given as percentage, 10% probability that they could default. And also it's the loss that would be incurred if the borrower defaults. So again, it might be what percentage of the loan could be lost. So again, the expected loss from extending credit, function of three elements. Number one, the amount the lender is exposed. Two, probability that the borrower defaults. And finally, three, the loss that would be incurred if the borrower defaults. Now we're down to the last learning outcome statement, the final two slides for this video. And the learning outcome statement I is define value at risk and describe its advantages and its weakness. So first of all, we have to learn what is value at risk. And value at risk gives an estimate of the minimum loss, not the maximum loss, the minimum loss of value that can be expected for a given period for a given probability. So there's three things there: minimum loss for a given period for a given probability. So you can see from the example, for example, a portfolio that has a VAR of 1 million for 1 day with a probability of 5% means that there's a 5% chance that the portfolio will fall in value by at least 1 million, minimum loss, in a single day, okay? And so value at risk is a standard metric. So some of the advantages is that it's a standard metric that can be applied across different instruments. So we can calculate value at risk for a bond portfolio, for a bond with zero coupon bond portfolio, for equities, for foreign exchange. So it's a standard metric that can be applied across different investments. And you can see it's going to give us a dollar value, so we're going to be able to compare, and we can allocate our risk capital appropriately. Another advantage is that it's relatively easy to calculate, and it's a useful tool for risk budgeting. And also, this is an important point to note, is that it is widely used and mandated for use by some regulators, okay? One of the tips that I would say is open up any annual report for a Canadian bank and type in the search functionality in the PDF document value at risk, and you'll see that it's a big topic through any of the big Canadian banks' annual reports. Value at risk. Okay, so the advantages: standard metric, easy to calculate, useful tool, and it's widely used and mandated by some regulators. Next, we're going to look at some of the weaknesses, and that will finish this video. Okay, some of the weaknesses of VAR, value at risk, to be aware of. Number one, VAR gives an estimate of the minimum, but not the maximum loss of value that could be expected. Number two, value at risk does not guarantee that a loss in excess of the VAR will not happen more frequently. Number three, VAR primarily relies on historical data to forecast future expected losses, but past returns may not be a good predictor of future returns. So that's a key major point, weakness of VAR, is that the future may not match the past, but the models, they're using historical data to help calculate, and well, that's historical, that's the past. The future may not be, the past may not be a good predictor of the future returns, okay? So in VAR often assumes that returns are normally distributed and follow a bell-shaped distribution, but that's not always the case. We learned in the quantitative Chapter 8 about fat tails and black swan potential catastrophes, and the VAR models assume that returns are normally distributed, follow bell shapes, so that's a little bit perhaps out of whack. Number 4, finally, is worth noting that the weakness related to VAR apply to all measures that rely on models, and it's known as a model risk. So that's the issue with regards to risk management, is that you use certain different types of models, but they have to be managed, and there's sometimes so many inputs, and it's the input that's not anticipated that happens, or the event that wasn't anticipated happens, and that's the weakness. The weaknesses related to VAR apply to all measures that rely on models. It's a model risk. Model risk is a key word. And I just wanted to finish by saying that really there's 3 methods that can be used to estimate value at risk. One is the parametric method, 2 is the historical simulation method, and finally 3 is the Monte Carlo simulation method. So again, these are different models, okay? So the final thought on this is that there's no single right way of estimating VAR. It's a tool, okay? And that's the end of the content for this video on this topic for this chapter. And that is the conclusion for this video for Module 7, Industry Controls, Chapter 18, Risk Management, for the CFA Institute Investment Foundations Program. Thank you.